Hey guys, this is Rudy coming at you live from Palm Beach in Florida. I've been traveling a bit and I've been away, but here I am back again. And what I want to do today is talk a little bit about energy and more specifically, energy transfer. The big question, the burning question that I want to ask is what other stocks do you think we could possibly consider for investment? Where you could buy it today for $16 and within the next year or so it's going to be trading at $21. So that's kind of the hypothesis behind me making this particular video. And then we can take a little bit of a deeper dive into energy transfer and see what's going on and why this should be at least on your watch list or perhaps even in your portfolio, assuming that you're comfortable with holding a master limited partnership or limited partnership in your portfolio, especially if you're a US tax person, because you will receive a K-1 at the end of the tax year, and you will have to do some extra filing when you submit your tax return to the IRS. But to start off, it is Thanksgiving because it's November the 27th today in the United States. So happy Thanksgiving to all our US viewers, and thank you for joining me. I've basically just decided to steal away for about maybe 20 minutes or so to walk through this presentation with you. So let's take a quick look here at energy transfer. Yesterday, which was Wednesday, November 26th, it closed at $16.43. You can see over the past 5 years, it's up 158%. So if you're looking at it from a short-term point of view, you're probably not too happy. But if you held it for 5 years in your portfolio, like I have, then you are probably quite comfortable with where it's currently trading at, even though it is down quite substantially, about 25 to 30% since January of 2025. I always tell people and remind you that if you can manage to generate 15% on an annual basis compounded, then you can double your investment every 5 years. So in this particular example, energy transfer has more than doubled in the past 5 years. Now, of course, the past 5 years also includes the buy-in that you could have done just post-COVID when you were able to snag energy transfer shares at about, $6, $8 per unit. You can see the high of January 24, 2025 was $21.05. For the sake of this particular video and for the sake of justifying my back of the napkin mathematics, I will use $21 as my fair value. I actually anticipate and think that energy transfer should be trading at $21. So however many shares you hold in energy transfer, assuming it's in your portfolio, if you hold on to them, in addition to sucking away the nice dividend, you can also multiply by your current shareholding by $5 per share. At the end of 2026, we should realize that price. Down here at the bottom of the screen, you can see that this is by no means a small limited partnership. In fact, its market cap is edging up to around $60 billion. And in addition to that, as I just mentioned, you could sock away a nice juicy dividend because it's currently yielding approximately 8% based on the current share price of $16.50. Now, let's look at these fair value estimates, right? So I just gave you my back of the napkin answer, and that was $21.05. I'm quite comfortable if it goes back to where it traded at its high in January of 2025. Some analysts are predicting the price in terms of fair value to be around $19.50 to $21.87, right? So my $21 is sort of in the middle of that range there. There are analysts with higher estimates up to even $43.30. There are also underlying problems with these valuations because they're either based on a peer comparison, which is really good from an academic point of view to see which of its peers might be a better bet than energy transfer if you're looking to invest at all. There is only one. I'll talk about that one in just a second. And then the other common valuation method that is used is called DCF. DCF stands for discounted cash flow. The problem with DCF is that there are so many assumptions in the model, and if you get one of the assumptions wrong, it's like dominoes, right? So then everything else is wrong as well. Not wrong, but your prediction perhaps might be off by as much as $10 or $20 if you arrived at $43.30 and you are an island because everybody else is anticipating about $20 and you're at 43. Of course, if that analyst were to be right, he or she would say, well, I'm the one who predicted it correctly and all of you were wrong. All right, that does happen sometimes, but it is quite unlikely. Energy Transfer is in the process of finishing several expansion projects for 2026. They're currently finishing up with some of them. I'll talk about some of those in just a minute. And there are some additional growth capital projects and potentially another acquisition within the next year. Well, there's a reason why I say there might be another acquisition within the next year, but let's sort of dive a little deeper and see what's going on with Energy Transfer. It's currently investing very heavily to complete some of these growth capital projects. The capex spending budget for 2025, 4.6 billion is up quite considerably from the 3 billion it was in 2024, and they plan to spend another 5 billion in 2026, so even up another 10% going into 2026. They are in the process of completing some major growth capital projects, including relocating Badger Gas and finishing its Nederland NNGL expansion project. There are also several new projects that should come online in 2026, including two new gas processing plants, the Lone Star Express pipeline expansion. There's a ninth natural gas liquids fractionation at Mont Belvieu, and the first phase of Brinson gas pipeline. So you can see these guys have been busy, right? So despite the fact that the shares are trending down and everybody's looking at this going like, what is going on with Energy Transfer? These guys have been busy, they've been hard at work, and there's a lot of stuff happening in the background, which doesn't always make the news, right? And these expansions, if you take all of them collectively and view it as on a go-forward basis, should result in significantly incremental cash flow by year end 2026, or perhaps even before that, right? So, what else is going on? So, on the insider shares traded, which is something that you can always look at to give you an indication as to whether you should buy or not. If you really think about it logically, if insiders are buying the company where they know more and have better information than what you and I could possibly have, then that's arguably a good thing. If the insiders are selling, unless there's a very specific reason as to why they are selling, which you could also try and dig up and see if you can find out why it is that they're actually selling, or you can speak to investor relations and ask them that question. But if the insiders are selling, then maybe you shouldn't be buying. You can be a contrarian. But when people who know the company better than you are exiting, that's probably not a good time for you to make an entry, right? So you can always look at the insiders. So this particular insider here, one guy, and I just took a snapshot because it shows you the last few months or so. His name is Kelsey Warren. So his last name is Warren. This is just inverted from NASDAQ. It shows you the insider trades for Kelsey Warren. He was the most significant buyer over the past few months. And you can see that he purchased in August 650,000 shares, followed by 1.3 million, followed by 1 million, followed by 1 million again. But look at the price, right? He bought these shares. So what do we have here? Almost 4 million shares. In fact, 4 million exactly. He purchased in tranches at 1730, 1736, 1695, 1681. So he bought 4 million shares. He is the CEO of the company and knows the company inside out. He's one of the founders. He knows the company better than you and I. And he bought 4 million shares at prices that are actually quite a bit higher than the current price that you could buy it at in the open market today. So what I'm suggesting here is if you look at Kelsey Warren, as a benchmark or an indicator in terms of insider sales, he's actually been buying the company's stock at prices that are higher than yesterday's close, which was 1643. So if you buy some, you are actually following the lead of the CEO in the company. And in addition to that, you are buying it at a lower price than what he bought the shares for. What else is going on? So I mentioned briefly at the start, another acquisition seems likely in 2026. Now, of course, I'm asking a question here because I couldn't possibly know in advance, and I wouldn't have the answer to that anyway. And if the insiders do have an answer to that, they are not sharing it with you because it's inside information, right? But Energy Transfer does have a history of consolidating the energy midstream sector, and they have made sizable acquisitions over the most recent few years, right? WTG Midstream for 3.3 billion just last year in 2024. They bought Crestwood for 7.1 billion the year prior to that, 2023. They acquired Enable Midstream for 7 billion in 2021 and Sem Group for 5 billion in 2019, right? So these deals have enhanced its operations and helped to fuel the accelerated earnings growth, but they haven't completed a deal in over a year, right? So we look back at their last acquisition, $3.3 billion in 2024, and you go like, well, they're probably slightly overdue. Why? Because they are in the best financial shape of its history, or in its history. They have a leverage ratio, leverage is debt ratio now that's lower than half of its 4.0 to 4.5 times target range, which means they have lots of flexibility to capitalize when the right opportunity emerges, right? So they are locked and loaded and ready. And I would not be surprised to see them make another acquisition in 2026. If we look at the dividends that the company is paying, you can see that the dividend has been increasing incrementally quarter over quarter. The current dividend pays you approximately 33.25, so 33 and a quarter cents per share. So take your shares and multiply it by 33 and a quarter cents, and that shows you what your quarterly dividend is. If you multiply that by 4, you get to $1.33, which is the annual rate. And at the current share price, $1.33 divided by 1643 is yielding just over 8%. That is a very good dividend. If you get an 8% dividend yield and the stock appreciates just 7% over 5 years, you would automatically be at 15%, which means you will be doubling your investment every 5 years, as I mentioned at the start. How about a peer comparison? So I mentioned that the fair value of the company is either based on its peers or otherwise using a DCF, which is a discounted cash flow model. And what we're looking at here are, according to Schwab, Energy Transfer's four closest rivals or peers. Now, some of the numbers can sometimes be a little bit deceptive, so you need to dig a little bit deeper when you look at the peers. And for the sake of this example, I've put two red arrows here at the top when we look at the overview slide, because what I'm actually suggesting to you is that there are only two of the five that actually look pretty good, and that's Energy Transfer and EOG Resources. You can buy and hold either one of these, and if you hold it for a 5-year period or so, you will do quite all right. Thank you. Don't be fooled by a number like the net profit margin here for TC Energy Corporation is significantly higher than the other two. So, of course, EOG has a high profit margin as well, and Energy Transfer has been lagging, but that's because they've been spending so much money on CapEx over the past year or so. The reason why I'm highlighting this is because EOG is just a good buy anyway, but I think there's more upside on Energy Transfer, and that's why Energy Transfer is my pick here. But this 33.96% net profit margin by TC Energy Corp could easily fool you. But if we go to the next slide, which is fundamentals, so the previous one was overview, and we look at the actual fundamentals, we see the same net profit margin over here. And you can see there's the consistency of EOG at 24% and Energy Transfer lagging at 7%. And TC Energy, of course, looked great at 33%. But down here at the bottom of the page, if you look at the earnings per share growth forecast over the next 3 to 5 years, suddenly these numbers flip because you have Energy Transfer at almost 12%, TC Energy negative, and EOG 6%. EOG at 6% earnings per share growth forecast over 3 to 5 years is pretty good, but 12% is off the charts, in addition to the fact that the stock for Energy Transfer is significantly undervalued, which is less the case with EOG Resources, which, by the way, as I said, is a good one. Let's go to Morningstar. So Morningstar is one of the analyst companies whose input and outputs in terms of their reports and their coverage on publicly traded companies I actually appreciate and enjoy. They do a good job. Morningstar has Energy Transfer rated 4 stars, so that's probably the highest rating in terms of its peer group anyway. And the fair value estimate is just 5 cents below my own because they have a $21 fair value estimate. And my personal fair value estimate right now is $21.05 because that was its high in January of 2025. This big blue blob on the screen here under this graph shows you that it's undervalued, and it's been undervalued for quite some time. And now is arguably a good time for you to potentially, as I said, either add energy transfer to your watch list or otherwise just open a position. Don't jump in boots and all, because if it pulls back more, you can always buy a little bit more, right? You don't have to, whatever cash you have available, whether it's, $100, $1,000, or $1 million, you don't just deploy and allocate all your cash at once, right? Buy it in tranches, put in a goodwill cancel limit order at a price that you like, and you can try different things. So you can buy it at 16.50. You can enter an order at 16.25. So if it pulls back a bit, maybe that one fills also. Buy it in tranches, play it a little bit, have some fun, right? So sticking with Morningstar, they usually have on their analyst reports a little section that says bears say and bulls say. They flip this the other way around, but I like to end on a positive note. So I read what the bears say first, and then I read what the bulls say. So the bears are saying its acquisitive nature, so it's always trying to make acquisitions, right? Leaves it vulnerable to overpaying. The problem with that is that when people in the market realize that you are on the acquisition trail, they will sometimes push the envelope a little bit and see if they can get you to overpay, or at least from a negotiation point of view, start mile high. And then if they have to, they'll come down a little bit, right? It's easier to come down in price than what it is to go up in price. So if you want to sell your company and you tell Energy Transfer you prepare to sell it for 5 billion, and at the end of the day you do a deal for 3.5 billion, which is wonderful for you, that doesn't preclude you from starting at 3.5 or 5 billion and ending up at 3.5. If you try to do it the other way around, it doesn't work. If you say you prepare to sell it for 1.5, they'll offer you one, and so on and so on, right? It has historically been the target of environmentalists and legal challenges. Energy Transfer is pretty much getting sued all the time. But, from time to time, and very recently, they won against Greenpeace. In fact, they almost put Greenpeace USA out of business. I'm not sure if Greenpeace USA still exists. But anyway, they're going to be less annoying going forward because Energy Transfer has basically crushed them. So yeah, they are a target, and there's always legal challenges against whatever it is that they do. Yield-focused investors may pass on Energy Transfer in a higher rate environment as debt could offer better returns. That one is unlikely because if anything, right now we are looking at rate cuts rather than a higher rate environment. So I doubt very much if debt could offer you better returns. What do the bulls say? It has a large and diverse footprint that enables it to pivot its investment and focus in areas of growth. It's an easy one. New data centers in Texas will benefit ET's intrastate assets, and it's well positioned to benefit from rising natural gas. Well, the first part of that comment is hopelessly hopeful, right? There's a little bit of hopium here. These new data centers specifically relate to Oracle effectively building new data centers in Texas. And I'm going to suggest that some of those data centers may never even get built. And Oracle itself is not doing so well on its big gamble on AI. So, bull safe, but yeah, that one doesn't have too much meaning to me. However, benefit from rising natural gas demand, and that for sure is an opportunity for Energy Transfer. And right here at the bottom, it says, as one of three major natural gas liquids exporters, it is able to win volumes through access to international markets. And of course, with all the geopolitical turmoil in the world today, including the sanctions against Russia and the China market, that's either growing or not growing, depending on whose propaganda you read. The bottom line is there are jurisdictions, including the European Union, that's desperate for well-priced or preferably inexpensive natural gas liquids. So there's lots of buyers, and right now we're still in a situation where the sale price or spot price for natural gas is actually lower than what it costs to produce. But of course, for Energy Transfer, as predominantly a pipeline operator, that doesn't really impact them too much because most of the revenue is contracted revenue, just moving the stuff through pipes, right? So sticking with Morningstar, very briefly here, this is Morningstar's fair value estimate, which I mentioned is $21 compared to its peers. And you'll notice some other peers here, right? We have Enterprise Product Partners, and that's EPD. and Williams companies and Kinder Morgan. So on the previous peer comparison from Schwab, I picked the two winners there was EOG and Energy Transfer, and here my two winners would be Energy Transfer and Energy Product Partners. Between those three, you could probably hold any of them in your portfolio and you would be happy. The difference here between Energy Transfer and the other three peers is that Energy Transfer is the one that is undervalued, whereas the other three companies on here are viewed as, by Morningstar, fair value. So if you want to buy an undervalued energy super major right now, in terms of where it's at and where it's currently trading at about 16 bucks and a few pennies or so, now might be a good time to add Energy Transfer to your watch list or otherwise to your portfolio. So that's my little story on Energy Transfer. I'd like to hear from you though, because as you know by now, I read all your comments and I try and respond to as many of them as possible. What do you think? Should we buy Energy Transfer? Should we hold it if we already have it in our portfolio? Or is now a good time for us to actually sell and exit Energy Transfer? So yeah, let me know what your thoughts are. For me, this is a major energy position that is very attractively priced right now. I've had Energy Transfer in my portfolio for a long time. With my additions to the existing position that I have, not only reinvesting the dividends, but in addition to that, I've also bought Energy Transfer along the way. I have a cost basis now of $10.56, I think it is. And the stock's currently trading at 16 bucks 43. So if we can get back to sort of $21 or thereabouts, then effectively for me, that would be a two-bagger. But in the meantime, I'm just collecting and socking away the dividends. So that's my story. Let me know what you think, and I look forward to chatting with you in the comments. Take care. Thanks for watching. Bye bye.